The only real methodology by which to reduce your exposure to capital gains and depreciation recapture is through a tool called the 1031 exchange. Okay, from Jonas. Jonas Aqua asks, if you complete a cost segregation study and decide to sell the property subsequently, what should you consider to prevent the depreciation expense from coming due? Very good question, Jonas. Very good question. It's actually pretty interesting because within the past few days, I actually did a reaction video on Instagram and TikTok to this pretty much a very similar question, right? An individual was talking about an investment property that they were going to convert into a personal use property in order to get the 2-year time frame running so that they can exempt up to $250,000 of their capital gains. What I commented on in that reaction video is when you have an investment property, regardless of whether you actually do this or not, if it is an investment property, the IRS will deem that there has been depreciation taken on that property. And if you fail to actually take it, they will just apply a straight line depreciation method and will have deemed that amount of depreciation to have been taken, regardless of whether you actually accounting for that on your taxes or not. So what that means is that if you do sell the property, not only is there potentially a capital gain event on the sale of an investment property, but there is also a depreciation recapture event, regardless of whether you actually depreciated the property. So this is one of those really interesting things that the IRS essentially has created this conundrum that if you have an investment property, you definitely want to be depreciating, because if you don't, they don't care. They're still going to deem that you have, right? And you are put into this scenario that when you do liquidate, there is this potential tax event. There is really only one way to avoid that taxation. And it is an avoidance mechanism, not an evasion mechanism. And it is a delay mechanism or deferral mechanism, not a zero out mechanism. So what I mean by that is the only real methodology by which to reduce your exposure to capital gains and depreciation recapture is through a tool called the 1031 exchange. You see, a Section 1031 exchange gives you the ability to defer the tax event on the sale of investment property until a future date. And when is that future date? Well, the future date is the time you sell a property without using a 1031 exchange. So as long as you sell the investment property utilizing the 1031 exchange methodology, you defer the tax event, and you can use the proceeds of the sale to invest in another property and essentially carry forward the basis of the original property into property B. But there are some rules that you have to follow. The very first rule is that the transaction must occur within something called a qualified intermediary. That is an actual quasi-escrow agent of sorts. And this qualified intermediary is the entity that actually handles the entirety of the transaction. So when you sell the property, it's not actually being sold directly by you, it's being sold inside of the qualified intermediary. The qualified intermediary is the one who receives the proceeds of the sale. You don't receive the proceeds of the sale. In fact, if you did receive the proceeds of the sale personally, it voids the 1031 exchange. So you cannot actually receive the proceeds. But what you can do is you can direct the qualified intermediary on how to reinvest those proceeds into a new property on your behalf. And as long as everything happens within that qualified intermediary, the tax event gets deferred into the future. There's a lot of complicated rules that deal with the 1031 exchange. There's a timing rule, meaning you have to have selected the new property you want to purchase within 45 days of actually going through this process of liquidating the actual first property. You also have to close on the new property within 180 days, within 180 days of the close of property A. So there's some deadlines from a timing standpoint. Thanks for watching. If you got value from this video and you'd like to see other videos like it on the concept and topic of 1031 exchange, go ahead and check this one out.